Good afternoon, and welcome to the City Club of Cleveland. I'm Dan Moulthrop, Chief Executive here at the City Club and also a proud member. It's my pleasure and privilege to introduce to you our speaker today, Thomas Curry, Comptroller of the Currency. Those of you in the banking industry know this already, but it's worth noting for our civilian audience that Mr. Curry is at the helm of one of the most important banking regulators in the nation. The Office of the Comptroller of the Currency, or OCC as it's known, is responsible for the charter and regulation of all national banks, more than 1,600 of the nation's financial institutions. The OCC has been playing this role since Abraham Lincoln was president. 152 years since the first comptroller was sworn in, we're here to discuss today challenges facing the banking industry. The importance of this topic goes far beyond the banks whose representatives are here with us today. Banks are a part of the vital infrastructure that keeps our economy moving. They are a partner to every small business and corporate enterprise, and their presence in a community can change the course of a neighborhood, a small town, and a main street. And they are in many ways under constant threat, from digital currency and the changing tools of commerce to cybersecurity and the ease with which fraud can be committed. There is no end to the ways in which banks see their business model challenged in the 21st century. Thomas Curry is the nation's 30th Comptroller of the Currency. He got his start in banking regulation in the 1980s in the Massachusetts Division of Banks, and in 1990 he became Commissioner of Banks for the Commonwealth of Massachusetts. He's also chairman of the board for NeighborWorks America, the parent organization of Neighborhood Housing Services of Greater Cleveland, and it is through their partnership that we are fortunate to host Mr. Curry. Ladies and gentlemen, members and friends of the City Club of Cleveland, please join me in welcoming Comptroller of the Currency, Thomas Curry.
Thank you, Dan, for the invitation to speak, and it's a wonderful introduction. I just wondered if I could get a show of hands before I start speaking about how many bankers are actually in this room, if you don't mind. Okay. I just wanted to verify something. I got some good counsel earlier this morning from Paul and from Dan that it might be necessary to address the banker problem in this room. And I do not want to be the person that destroyed an illustrious tradition of the City Club that there were very few questions asked at this session. So given the fear of regulatory retribution, I want to grant every banker in this room absolution. Anything you say will not be used against you. You will not have a management rating change. You will not have a Camel's rating changed. There will not be an army of examiners at your doors tomorrow morning. Unless you push me. It really is a pleasure to be here in Ohio. Dan mentioned Abraham Lincoln. I'm very much aware of the history of the club in Ohio itself. And honestly, I would not be in the position that I hold today, or would my agency exist, but for some Ohioans. The names Salmon Chase and John Sherman may not be as well known as LeBron James, but without those two 19th century Ohioans, Chase, who was President Lincoln's Treasury Secretary, and Sherman, who steered the National Bank Act through the Senate in 1863, we would not have the national banking system we have today and its great contribution to the economic development of our country over the past 152 years. And Ohio continues to be a major source of talent for the banking and financial policymaking arena in Washington. Your former Attorney General Richard Cordray is head of the Consumer Financial Protection Agency, or Bureau, and he and I work very closely together by necessity, actually. And likewise, I have regular contact with Senator Sherrod Brown, who is the ranking member of the Senate Banking Committee. So I was very pleased to have this opportunity to visit their home state, and especially to address the City Club. And in fact, yesterday, Senator Brown called me to give me a brief history of the club in advance of appearing here. And it really is impressive that for over 100 years, the City Club of Cleveland has been a leading forum for the discussion of key national, regional, and local issues. And I'm really honored to be able to participate in this forum today. The Office of the Comptroller of the Currency is, as Dan mentioned, the primary regulator and supervisor of national banks and federal savings associations. And as I mentioned, we've been doing that for more than 150 years. And I think it's important just to mention what our mission is, and it's to ensure that national banks and federal savings associations operate in a safe and sound manner, provide fair access to financial services, treat customers fairly, and comply with applicable laws and regulations. My remarks today will address the balance that the OCC must strike in providing guidance to banks. It's our job to ensure financial safety and soundness through proper risk controls, while at the same time, and this is really the art of it, leaving room for innovative financing, including financing that can help revitalize our communities. And in that vein, I'd like to share a few thoughts about an issue that has been near the top of our national agenda: urban stabilization and revitalization. Cleveland, like many other Midwestern cities, has shouldered more than its share of foreclosures, shuttered manufacturers, and population outflow. We know that it takes imagination, innovation, resourcefulness, and persistence to truly transform a city. And it also takes a huge investment of financial resources. As a regulator, I'm deeply interested in the role that our financial institutions are playing and must continue to play in the revival of America's cities. Cleveland can point proudly to dozens of examples of projects that bring together the public, private, and nonprofit sectors in a common effort to continue the city's revitalization. So let me discuss with you today what the OCC is doing to support these efforts. Before the financial crisis struck, bank loans and investments were driving the building and rebuilding of homes, office buildings, and the infrastructure in some of our cities that are in most need of reinvestment. For the first time in many years, there actually was real progress and real hope that in at least some places that we had turned the corner. Then the bottom fell out of the housing market. Whole neighborhoods were abandoned, foreclosures skyrocketed, and even today, despite the general recovery of housing values, millions of homeowners are still underwater, limiting their mobility and their financial options. I'm pleased to say that the banking system has significantly recovered from the economic catastrophe of 2007 to 2009. And there are many reasons for this, including an enhanced regulatory regime that holds banks to higher standards of risk management and corporate behavior. Bankers today are focused on finding ways to show that they can be both profitable and responsible. And in cities across America, and especially in places where the housing recovery is still lagging, bankers' efforts are producing real results. Let me give you a few examples, including one just minutes away from where we are meeting today. Slavic Village was especially affected by the recession. At one point in 2007, it was widely reported that more foreclosures were recorded there than anywhere else in the country. By 2013, 1/4 of its homes stood empty. Without question, the mortgage crisis was a significant setback to that community. What is remarkable, however, is how the community has fought back. One OCC-supervised institution that has called Slavic Village home for decades is leading the way by investing in community organizations. Today, residents who toughed it out through the bad times have joined the banks, nonprofit community development organizations, private sector supporters, and local government agencies who are working together to create a new, revitalized Slavic Village. The Greater University Circle Initiative, which has leveraged the combined efforts of area universities, museums, and hospitals, is another fine example of the public-private partnerships that are needed to carry out comprehensive strategies. These institutions, joined by thousands of area residents, are working to rejuvenate an area that includes several Cleveland neighborhoods. Financial institutions have provided leadership and funding for this initiative, ensuring that capital is available for development, mortgages for new homeowners, and small businesses. Earlier this morning, I had the opportunity to meet with Lou Tisler from Neighborhood Housing Services of Greater Cleveland and representatives of other NeighborWorks organizations who are doing great work here in Cleveland and in Ohio. Yet the problem of foreclosed or abandoned properties persists in many Cleveland communities, in other older industrial cities of the Midwest, and elsewhere. One promising strategy to address this problem is the land bank movement, exemplified here in Cleveland by the Cuyahoga Land Bank, and I screwed that up and I apologize, which was established in 2009. The Land Bank is a nonprofit government-affiliated entity that operates under enhanced powers granted by the Ohio legislature. The Land Bank was thus enabled to organize as a corporation, which fostered more efficient property disposition processes. In addition to acquiring properties foreclosed for tax liens, the Land Bank has been the recipient of low-value properties donated by investors, including a number of national banks. The Land Bank has adopted a number of sophisticated strategies to acquire and dispose of properties. It partnered with a local university to develop a data tool that now aids in the decision-making about which neighborhoods and properties to target for revitalization and rehabilitation. Some 60% of the Land Bank's properties are beyond repair and are slated for demolition. In many cases, banks are paying for the demolition cost on properties they donate, so the Land Bank does not have to absorb that expense. For properties that can be rehabilitated, the Land Bank has developed a creative housing program to foster home ownership and to ensure that renovation work is done properly and promptly. A deed and escrow program gives buyers an opportunity to purchase a home, with the Land Bank holding the title in escrow until improvements are made and are up to the standards set by the Land Bank. If the rehabilitation is not completed on time, the Land Bank can retain ownership, which give buyers a strong financial incentive to comply with the program's terms. The Land Bank offers several other home ownership programs. Properties that only need a modest level of repairs are offered on a first-look basis to prospective homeowners, which gives them an advantage over local property investors. Two programs offer discounted purchase prices and a lease purchase option to serve veterans and to attract college graduates. Obtaining financing, however, has been a major challenge for buyers in Cleveland, and this is true for others in other cities. And this is not very surprising. When one considers that many banks took huge losses on mortgage portfolios during the financial crisis, some bankers are understandably hesitant about making mortgage loans in cities that skeptics have written off. Lack of access to credit is a key issue and is one that arises in part from certain misconceptions about supervisory standards and expectations. And that's really what I want to focus on in the remainder of my remarks. And it is certainly true that the OCC has raised its expectations regarding credit underwriting and loan portfolio management since the end of the financial crisis. The OCC and the other financial regulators also updated our longstanding guidance addressing appraisal and evaluation practices. These guidelines built on the existing regulatory framework and reaffirmed the agency's supervisory expectations for sound collateral valuation processes when originating or modifying real estate loans. Additionally, the interagency guidelines for real estate lending provide that institutions should require a loan-to-value limit of 90% for all 1 to 4 family residential mortgages unless there are appropriate credit enhancements. In some markets, and particularly for low-value properties in hard-hit communities, we have heard that these supervisory policies might present challenges in the lending process. A further concern is that many properties in these communities may require substantial renovation to make them habitable, and those renovation costs also need to be financed. Sound appraisal and evaluation practices depend on having meaningful comparable property sales to draw on when performing valuations. However, in distressed neighborhoods with limited sales activities, finding comparable property sales is more difficult. And in some areas, values have been driven down by discounted investor cash sales, short sales, and foreclosures, which may depress market values throughout the community. The challenge of performing an appraisal or an evaluation in a hard-hit community can be particularly complicated for appraisers who are also less familiar with the area. We've heard from national banks and federal savings associations that want to support and participate in programs like the Land Bank in Cleveland and elsewhere, and are concerned legitimately about how to do so with the current regulatory framework and supervisory expectations. We have tried to address these concerns by pointing out that the supervisory standards discussing the 90% loan-to-value limit for residential lending do not create an ironclad ban on lending above that limit, even if there are no credit enhancements. Indeed, the standards themselves acknowledge that lending above that limit in excess of supervisory loan-to-value expectations can be consistent with safe and sound lending practices in specified circumstances, provided that banks maintain appropriate controls and otherwise comply with applicable law, regulation, guidance, and the bank's own policies and procedures. Supervisory loan-to-value exception loans may be a means of addressing circumstances facing borrowers and lenders in rehabilitating housing stock in communities that have suffered significant declines and have been targeted for revitalization. But we also must make sure that when circumstances justify these loans, the interests of both lenders and borrowers are both protected. To provide greater clarity about our supervisory expectations, I recently asked OCC supervisors and specialists in fields such as credit risk, community development, and consumer compliance to come together internally to consider how we might support urban rehabilitation efforts through programs that include loan-to-value exception loans. While we have not yet resolved all of the many questions these loans present from a supervisory standpoint, the OCC believes that it is quite possible for loan-to-value exception loans to be made in a safe and sound manner if appropriate parameters are observed. And let me outline some of these important principles that should be considered. For instance, in addition to the general lending policy regarding limits and standards that we expect of all banks to maintain, banks should consider adopting specific policies and procedures that, among other things, identify the proposed geographic area, anticipated financial commitment, and duration of this type of specialized loan program. Additionally, other factors may include specific underwriting and evaluation standards, compliance responsibilities for these loans, and internal monitoring and reporting requirements that assess the performance, impact, and success of the loan program. And it would be very important for the bank's board of directors to approve and monitor these policies and procedures. As always, the OCC examiners would be available to provide feedback as institutions consider ways to assist in the redevelopment and rehabilitation of these communities through programs like the Land Bank. Addressing these issues is one piece of the solution for helping distressed neighborhoods. But all of our efforts to rebuild stronger communities also speak to a larger question about our nation's future. Since the end of the financial crisis, home ownership levels have been in steep decline. Recent reports tell us that they are at the lowest that they have been since 1967, wiping out nearly a half a century of progress in making our communities safer and more stable. The question which has taken on added urgency since the end of the financial crisis is whether we can reverse this trend and provide more of our citizens with the opportunity to own their own homes with fair and sustainable mortgage terms. I believe that we can, but it will take continued constructive collaboration between the public and private sectors, as well as a major commitment by our financial institutions to get us to that point. And I could assure you that the OCC, as the supervisor of the federal banking system, will do everything in our power to make that happen. And thank you for your time, and I'm more than happy to answer questions on this and any other topic that you wish. Thank you.
Great. Thank you, sir. You can sit down for a second. Plenty of time for lots of questions. I'm going to hand you that. Okay. Today we're enjoying a forum featuring Thomas J. Curry, Comptroller of the Currency. We encourage you to organize your questions for our speaker now and remind you that your questions should be brief and to the point. If you're joining us via our webcast and would like to tweet a question, please tweet it at the City Club. We welcome all of you here and those joining us via our web stream provided by our primary media partner, 90.3 WCPN, WVIZ PBS, 104.9 WCLV Idea Stream, or one of the many radio stations across the region and country that carry City Club programs. Television broadcasts of the City Club are made possible by Cleveland State University and PNC. Be sure to join us this Friday, September 11th, for a conversation with Anisfield Wolf Book Award winner Marlon James, author of the novel A Brief History of 7 Killings. For more information about our upcoming and past forums, please visit us online at cityclub.org. Our community partner for today's program is Neighborhood Housing Services of Greater Cleveland. We thank you very much for your support. Additionally, we welcome guests at tables hosted by Citizens Bank, Fifth Third Bank, Key Bank, PNC, and Squire Patton Boggs Bank. Just kidding. Okay. Now it's time. We thank you all very much for your support. Now it's time to return to Mr. Curry for our traditional City Club question and answer period. We welcome questions from everyone, including guests. Holding our microphones today, our City Club Content Associate, Teddy Eisenberg, and our Director of Programming, Stephanie Jansky. Can we have our first question, please? There we go. I was about to jump in.
I may ask you to, yeah.
Do you think there's been a permanent or semi-permanent shift in consumer preferences from buyers to renters? And if/why is this a problem?
Okay. I think we're really seeing the financial crisis and the mortgage crisis and the foreclosure crisis all, I think, and this is really the basis of my remarks, really represented a fundamental shift in home ownership. I do think that strategies for dealing with housing really have to be larger than just home ownership and look to other forms of providing affordable housing for individuals. And that includes the entire range of ownership, whether it's individual homes or rental apartments.
Financial literacy continues to be an ongoing issue in this country. Does the OCC or any other regulatory entity have any plans to partner with educational entities to address that earlier in life?
Financial literacy has been a major focus of all the bank regulatory agencies and the Treasury Department. There actually is a Treasury Department-sponsored initiative to deal with these issues. It includes the regulatory agencies, academics, and other practitioners in the area of consumer protection and financial literacy. When you look at some of the underlying causes for unfortunate financial outcomes, whether it's foreclosure or bankruptcy, fundamentally it's a lack of understanding of what the basics of finance, banking in general. The greater emphasis we place on financial literacy at appropriate age levels is really the first defense against unfortunate outcomes for individuals.
Mr. Curry, you wear two hats at least, one as chairman of the board of NeighborWorks and also, of course, comptroller of the currency. Can you talk a little bit about how your role as chairman of the board of NeighborWorks informs your thinking as a comptroller?
Sure, thank you. NeighborWorks is an interesting organization. It's actually a congressionally chartered organization established by federal law. It's appropriated by Congress on an annual basis, and it makes grants to NeighborWorks organizations. But really, what its value is really as a network of excellence. It has high standards. And it is, for the bankers in the room, you might find some comfort in this. The way it operates is roughly analogous to the chartering and regulatory structure that banks are subject to. There are organizational assessments of NeighborWorks organizations like Lou's. They are required to meet managerial and financial standards, and also to be able to document and justify how they're meeting unmet needs. The role of the bank, of the OCC and the other regulators is very interesting, and I think there's a lot of crossovers. Congress mandated that the Comptroller of the Currency, the Chairman of the Federal Reserve, the Chairman of the FDIC, the Secretary of HUD, and the Chairman of the National Credit Union Administration serve as the statutory board of NeighborWorks America. And if the individual does not serve, it is required that a presidentially appointed and Senate-confirmed member of those other boards actually serve on NeighborWorks boards. That really has been, I think, very beneficial to the regulatory agencies. We're required to assess individual banks' compliance with the Community Reinvestment Act. NeighborWorks is a unique window into that arena, other than through the banks themselves. So it gives us a bigger or clearer picture, and it really there is a focus on the CRA on community development, particularly for large banks, those institutions subject to the large bank procedures and requirements. So it's a very beneficial and mutually supportive relationship to both the OCC and I think to the NeighborWorks America organization and the NeighborWorks affiliates throughout the country.
Just to tailcoat for a second on the question that was asked before this one. In terms of financial literacy, are there efforts being made to reach out to those who may have come to this country from other countries and are struggling with the English language, or perhaps buying their first home?
Yeah, I think the approach is across the board, and it's been that way historically. I'll just give an example. I actually still serve as an ex officio member, but served for over 10 years on the FDIC board. They have a very good program, Money Smart. It is available in dozens of languages and targeted for a variety of ethnic groups here in the United States.
Thank you, Comptroller Curry, for being here today in Cleveland, and we thank you for your remarks. We are on the 8th anniversary coming up next week of, I think, many of what we all recall as the beginning of the financial crisis, as we all knew it. And as we stand here now, what macroeconomic variables do you all watch in the OCC to try and gauge economic strength? And as we go into what will probably be an inevitable downturn, what are the opportunities and challenges between regulatory agencies and banks to make sure we're supporting our communities, our consumers, and appropriate credit is available?
Yeah, thank you, Beth. I think a real formative experience for all of those that are affiliated with banks in this room really has been the financial crisis, and it has had a lasting effect, I think, certainly on the regulatory structure through the Dodd-Frank Wall Street Reform Act, but also I think, and probably important its impact on us individually in the way we think about banking and some of the risk management practices or standards that we had in the past. So being a optimistic pessimist, I am hopeful that the there will be a positive outcome to a very unfortunate experience that we all suffered. In terms of where we are today than 7 years ago, I think we lived and breathed on what was going on elsewhere and throughout the global economy. I think as regulators over time, we focused in on Europe, and other crises, wondering if that would be a triggering event for further destabilization with our financial institutions here in the United States or our economy. I think that we do have a global economy. What happens around the world will have an impact. It's really our ability to measure what we think the direct impacts are and also what we think the indirect impacts will be. Some of the more recent activity or instability in China, for example, I think from a bank supervisory standpoint, we believe there's very little direct exposure to China, but yet again, the unknown is, what is the potential indirect impact through an impact on our economy, some knock-on effect. But again, a difference between now and the onset of the financial crisis, we have a much, much stronger banking industry. The capital levels in our industry, the adequacy of the reserves, the risk management practices within our institutions are substantially higher than they were going into the crisis. And again, one of the lessons learned, you have those shock absorbers, those the switches in place. It will make our ability to handle future external events so much easier. And at the end of the day, what I think is important and learned professionally as well, you need banks to have a strong economy. A weak bank is not going to help the economy. So going into any crisis with a strong system, and I think we have a strong system today, we will be able to withstand more economic shocks if they come our way.
Good afternoon. Specialized residential mortgage lending products virtually disappeared after in the wake of the financial crisis. On a good day, what message do you hope your regulators are sending to banks these days? And by the way, when I say specialized, I mean prime mortgages, responsible, targeted to moderate income buyers. And is that messaging from them today sort of genuine, or is it yes, but here's all the extra paperwork? Thank you.
Well, there's a couple of things in your question. I hope I get them. One, we expect well-managed and well-capitalized banks to make appropriate decisions on what types of products and under what terms they should make to consumers. And there are a host of regulatory requirements and rules that should make those products appropriate for the individuals and their financial circumstances. I think what's going on is, there are things that are left undone from the financial crisis and from the subsequent Dodd-Frank Act. We're getting better in terms of having the rules of the road in place. I think most of the mortgage-related changes of Dodd-Frank have been enacted. There are some that are still out there. An example being the CFPB's changes to the truth in lending and RESPA requirements. I think that from a safety and soundness perspective, we are telling our institutions that they should continue to lend. That in terms of we enforce CFPB rules for banks under $10 billion. That we understand that there's transition periods in place in terms of what our regulatory response would be for minor or other infractions. The bigger picture factors on prime mortgages being available to consumers, I think, deals with the fact that the government-sponsored enterprises, the GSEs, that issue has not been resolved. There have been, just read the news and the securities filings. There have been substantial settlements with regard to lending that was done during the crisis, so that I think there is a hesitancy to to expand activities or the level of risk a bank is willing to accept. Again, I think over time, as we get more clarity as to what the expectations of the GSEs are in terms of reps and warranties and other issues, that there'll be more comfort and willingness on the part of banks to lend on more potentially broader or appropriate terms.
Good afternoon. Currently, banks in this country are regulated not only by the OCC, but by the Federal Reserve Bank and by the FDIC. What are your thoughts on changing that to have one regulator regulate all of the banks in an effort to save cost and improve consistency?
Okay. I actually kind of have a unique background. I've done worked for almost all the agencies involved. And I actually think that it's very appealing to have that clarity of structure or on an organizational chart. But I've been around long enough to see that there are some actually advantages to having some diversity in the regulatory structure. As a bank regulator, we have enormous authority and ability in terms of our oversight of banks. I think it's important to have some checks and balances, the ability to have a dual chartering system, and to, under appropriate circumstances, not because you're facing an enforcement action, to switch regulators may be beneficial and be wise. I think that the different regulatory agencies have different missions, and that actually translates into a different, same rules, but a different approach in how those rules are applied. I've been a state bank commissioner. I've been on the FDIC board for the last 11 years. And I've been a comptroller for the past 3 years. At the comptroller, we're a chartering entity. So part of our mission is we're here for banks to serve their communities and local businesses. We view banks as going concerns, requiring oversight given the federal safety net and the chartering of those institutions. The FDIC has a very important mission, and they performed admirably, but they are an insurance company. Insurance companies are, their underlying mission is really to reduce the risk of loss to that insurance fund. I think you get a healthy tension by having different regulatory perspectives. Now, that doesn't mean that you should, have bitter interagency infighting at all. And one of the things that I've insisted upon becoming comptroller is we have an obligation as regulators to work towards greater collaboration, not coordination, collaboration between the agencies. And I would point specifically to the FDIC, the Fed, and the CFPB. In terms of the collaboration I'm talking about, 3 years ago, particularly with our larger institutions, we took the step, initiated actually sharing our annual supervisory plans with both the Federal Reserve System and the FDIC, so that they know what we were doing, that we could discuss what their objectives were. And what I think is the goal of supervision is to make sure that we're harmonizing what we're doing. At a minimum, they're not tripping over each other and any of the banks in this room. And at the end of the day, have a better supervisory process. I don't know if you'd actually have that if you combined all the agencies. Maybe you would, but I don't think it's a guarantee. I think the area where we do need to work on greater coordination and harmonization is with the CFPB. We've come a long way since they started as a startup in government, and that's something that I've paid personal attention to in building a relationship with Rich Cordray for a variety of reasons, not to have us trip over each other, say in Beth's Bank, but also, I think it's very important in the rulemaking function of the CFPB for consumer protection that they understand the context. And the context is something that I think the OCC understands as the prudential regulator. And we've been actually very successful in making, by statute, we're required to consult. The word is consult before any rulemaking. And when I first came to Washington, what consultation consisted of, we're going out with this rule in 4 o'clock this afternoon. Tell us what you think. We are actually, and you can quibble over the outcome of the actual rules, but we actually talk to the CFPB in their development stage of their rules. We share drafts, and it is actually a collaborative process. At the end of the day, who calls the shots? We don't. But there's a clear recognition by Rich Cordray and his senior people that this is a healthy process and is really invaluable to their work and to our work as well.
Hello, thank you for your speech. Do you believe that alternative lenders, so online lenders, peer-to-peer lenders, will be disruptive to the traditional banking sector? And given the issues we've talked about with financial literacy, that they are transparent enough for final consumers?
Yeah. No, I think banking. People have this misconception that banking is this staid industry. It really is a dynamic industry, and really what. The disruptors or whatever you want to talk, alternative lenders you want to talk about, really are part of the process, or evolutionary process of, determining what's the best way to meet changing customer preferences or demands, and basically how do you incorporate innovation into your delivery systems of products. One of the concerns I might have is if you have a fragmentation of the banking industry as a part of this process, it is important that banks not become simply a transactional type of utility. There's a value in the whole thing being both a deposit-taking, transactional focused part of the payment system, but also the asset side in terms of lending and the economic strength and decision-making process that banks have in place. So what I'd like to see is really a future evolution of how we approach both the design of products and their delivery, but also to make sure that we don't lose the value of having an integrated entity that's been called a bank for at least the last 2 centuries or so.
Thanks for coming. Critics of our economic policy in the past have cited the CRA as a big contributor where there were lax lending standards. What do you think of that?
I actually don't agree with that. I think there have been each of the federal banking agencies have stated that that's not their position, and there's been research done by some of those entities as well to support that it's not. I do think what really happened was a disregard of traditional underwriting requirements and a lack of effective quality control or oversight of the loans that were being made and packaged into securities. And that's really what I think happened.
Thank you for coming to Cleveland and your presentation here. My question is that could you update us here on what regulators like the OCC and others are doing to protect our banking system from cyber attacks and from the current turmoil in China?
Okay. We at the OCC view and have viewed cybersecurity as a major threat to both individual institutions and to our banking system. And it's really an area where we've paid a great deal of attention to over the last few years. There was a decision made early on that in terms of how we approach the supervision of banking institutions, and I'd include credit unions in that that we needed to have a consistent process and approach with all the agencies. So it was agreed early on that we would coordinate our activities through an entity called the Federal Financial Institutions Examination Council, or FFIEC. And really the focus of our efforts over the last 2.5 years have been really to increase awareness among the entire industry, from the smallest credit union or community bank to our largest financial institutions, of the significance of this threat, that it really was not just something your IT department had to pay attention to, but it really had posed a major threat to the entity and really was of a concern to the CEO and to the board directorate. What we are really working on now is really making sure that we help provide some of the informational and other tools to the industry to combat the threat, the present and continuing threat. So the emphasis has been on, if not mandating, when a regulator says strongly recommend, you should kind of wonder whether they mean mandate. Information sharing through FFISEC is really what we really think that it's important to have a two-way street and speed of information relative to potential cyber attacks or threats to be shared and processed through the industry. We also, the best defense is you're defending your own home. We launched a cyber assessment tool, or CAT as some people are calling it, so that banks can do a self-assessment, and that assessment would be consistent with some of the principles of NIST and other pronouncements, but to get the banks to be thinking about it internally. And that really, the emphasis there has really been on the smaller banks, so that they can really assess what their real threats are as opposed to other threats. We're also focusing our supervision activities under the Bank Service Company Act on technology service providers who serve multitude of financial institutions, both large and small, because that's really a potential weak point in the system. So that's really being geared up. And then this will be and will continue to be a major focus of our ongoing supervision of all institutions through the examination activity, through clarification of policies and procedures. Why it's important, and I should probably have said this earlier, banks are built on trust. Cybersecurity is really, you're really talking about your electronic vault. You've got to protect the vault. That can hurt an individual institution's reputation at a minimum for safety and security of financial information. It can also cause losses if there are significant fraud losses that aren't covered by insurance or by sufficient capital to absorb the extent of any losses. And then this is something, I serve also on the Financial Stability Oversight Council, which was created by Dodd-Frank to look at the macro threats to our financial system with membership of all the financial regulatory agencies and the Treasury Secretary. And you mentioned China. It really is a national security threat as well. If the system, through one individual institution or through repeated breaches, causes core systems to be corrupted, that banks cannot have accurate records as to what account or other custodial type of information, you really have the potential for destroying trust in the system. And that is really important and something we're focused on. And we're dealing with it from a supervisory standpoint, and also, and I give great credit to Treasury Secretary Liu and Deputy Secretary Sarah Bloom-Raskin. There really is a need for the utmost level of coordination between government agencies beyond the regulatory. This deals with national security agencies that have information and tools that are important to the financial system's ability to respond. And there can't be gaps in communication on an intergovernmental and government-to-industry basis.
Can you expand on the importance of a strong risk culture and share with us specific examples around best practice?
Mm-hmm. Yeah, this is, you talk about lessons learned. That was one of the lessons learned by the OCC from the financial crisis. Back in 2010 or 11, the OCC, from a risk management oversight standpoint, identified this concept of heightened expectations. And to try to boil it down, basically, we're saying for the largest institutions that we supervise, and this would be, a graduated scale of expectations depending on the size and complexity of the institution, that we would expect that they would have the, not just satisfactory risk management practices, not just satisfactory internal controls, but really the highest standard, strong. And what we've done since 2010 is actually rate the 19 largest institutions that we supervise where they are in key areas. When I became comptroller, I thought that process was too informal and lacked clarity in terms of what those expectations were in the corporate governance and risk management area. So a little over a year ago, we promulgated what we call heightened standards under our authority to prescribe safety and soundness guidelines. And guidelines is a misnomer. They're guidelines, but they're enforceable by statute. So, we've basically turned up the heat in a sense, and that's probably too strong. This is important. We really view that heightened risk management is the key for larger institutions to be successful and to reduce potential risk to themselves and to the system. That is something that now is codified, and it is also being assessed on an ongoing, regular basis through our examination activities.
Good afternoon. I just wanted to circle back for a minute to the CRA. Mm-hmm. You mentioned it earlier, and you mentioned also that banks are dynamic and our financial industry is dynamic. The CRA is a regulation that's been around for decades with very little change. Mm-hmm. Can we expect some substantive review and change in the coming years, maybe 1 to 3? And if so, what changes would you like to see to the CRA, if any?
The CRA really hasn't had a major change since, I think, it was 1995 when the CRA regulations were reissued, and I think that was really a major event. The problem that I think you're alluding to is the fact that by statute, the CRA really is tied to geographical areas in which fiscal branches of an institution are based. The nature of banking has changed substantially. Electronic and other means of delivery kind of, changed the dynamic. There's also, I think, introduction of, the question in the back of the room, different non-bank players in the same marketplace. It is probably not there will probably not be any substantive change to the regulations in this environment. And some of the changes that some have argued really would require a statutory change, which I think is even more unlikely. What the agencies have done over the last 4 years or so is really to utilize the CRA question and answer format to try to flesh out some of the answers to the questions about community development. How do you meet your obligations under the CRA, and the commitment by the 3 banking agencies, including the OCC, is that this should be a ongoing, rolling process. I use the word rolling with the intent that it would be on a fairly regular basis, but apparently other people have, including my own staff, have a different view of what rolling means.
A three-part question. There's been several discussions noted by members of Congress, presidential candidates, about re-implementing the Glass-Steagall Act. So what impact would this have on the industry? Has there been discussion with the OCC and other agencies on this, and what impact would it have on neighborhood development initiatives?
Okay. I try to keep things simple as a rule, and as a member of the executive branch, I do what Congress tells me to do. So, until I'm notified otherwise, my job is to implement the existing, the pre-existing banking laws as they've been modified by the Dodd-Frank Act. So that's really what's occupying our time, is actually finishing up the many rules that Dodd-Frank instituted, whether they're the mortgage-related rules, the Volcker rule dealing with proprietary trading by banks, whether it's some of the heightened prudential requirements that were mandated by Dodd-Frank. I do think, and I mentioned this earlier, I do think given the capital levels, increased capital levels of the banks, stronger risk management expectations by the regulators, some of the the hardwired features of the Dodd-Frank Act, that you do have a much safer system, and others may differ as to how much risk they want in the system or not. But as a bank regulator, we are committed to using the tools that we have to try to assess and mitigate the risks that we see in our individual institutions. And it's not just exam-related things. It's again, some of the lessons learned from the crisis. I do think that regulators need to be more transparent about what they see and what they're focusing on. I think that's something that the OCC has really pursued. We publish a semi-annual risk perspective where we actually list out what we think the major supervisory issues are with our large banks and with our community banks. And that is really a roadmap of where we are going to be focusing our entities. I think that's healthy for a variety of reasons. One, it requires us to articulate and to arrange the risks that we see and to allocate our resources appropriately. It's also appropriate to signal to the industry where we think they should be paying attention as well. And I think it's important to the public that they have some ability or inkling to see what the supervisory part of financial reform, what the supervisors do on the ground, what that means and how it affects the stability of our financial system.
Today at the City Club of Cleveland, we've been enjoying a forum with Thomas J. Curry, Comptroller of the Currency. Thank you very much, Comptroller Curry. Thank you, ladies and gentlemen. Our forum is now adjourned.